Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. Our note released on Saturday, May 1st this week was titled Substantial Further Progress. That's a phrase that the Fed added into their directive back in December. And during Chairman Powell's press conference last week, he made it very clear that you should be thinking about the labor market and any substantial further progress that it has made benchmarked back to December. So that was the title of our note. And one of the sections of the note was really all about the labor market. This will serve as our podcast, also our video that our friends at Nucleus 195 will help us with this week. One administrative note, which is we will be traveling back east next week. We'll be in Boston and New York. We should be able to get a podcast together next Monday morning. Though videos a little more uncertain at this point. But there were four sections in our note this week. There was a section we titled Dissing the Supply Side. It was a discussion of how Keynesian economics is dominating policy at the Fed and at the federal government level at this point and the potential implications of that. The second section was really honing in on the Biden tax plans or Biden job and family plans. That section was titled Tax and Spend. The third section of the note was about the labor market. It's titled Substantial Further Progress. And one note that there will be a chart book that'll go out for our paid subscribers only that will have a series of charts really delving into the labor market ahead of this Friday's payroll report, which we view as absolutely critical to Fed policy in particular. And then the fourth section of the note was titled As Good as It Gets, and it was a reference to the momentum that we see in the manufacturing sector, PMI, purchasing manager surveys, manufacturer regional Fed surveys and the like, as well as corporate earnings and the just blowout numbers we got from big tech last week. So those are the four sections of the note. To begin with, this disrespect for this supply side, everywhere we turned last week, we saw clear disrespect for this, for supply side economics. Our old friend Larry Lindsey was on CNBC last week talking about how the Biden plan is in essence plan to tax the supply side of the economy and increase aggregate demand. And you don't need a PhD in economics to know that if you reduce supply and increase demand, that the price goes up, meaning there's inflationary implications to that. We also had an interview on CNBC last week where Kelly Evans, our good friend, was asking us about whether consumers would actually pay higher prices. And the more we thought about it after the interview was through, we realized that there's this sort of core assumption that the reason inflation was soft was because of weaker aggregate demand, consumers' unwillingness to pay higher prices. Our response to the question was, they've been paying higher service sector prices. They've been growing better than 3% throughout the entire 3-decade disinflationary shock. So that really wasn't the cause of lower inflation. It was a giant supply side increase in the supply side of cheap labor, which was the integration of China and the Soviet bloc into global supply chains that deliver those goods. And it was the supply side that caused prices to go down. Now that there's not that same abundance of cheap labor, that we don't think we'll get that disinflationary impulse from the supply side. So in fact, there's stresses on the supply side through global supply chains. That's more likely, again, a supply side issue that will push prices up. It really never had that much to do with aggregate demand. That the other issue was that we thought was humorous around all this was Chairman Powell in his press conference being asked about the lessons of the 1960s and whether he, of course, responded that, yes, they understood the lessons of the 1960s. And for me, I was bemused by that in as much as the lessons, the way they were taught, given the age of the participants of the FOMC, they were taught the lessons from people like Paul Samuelson that got us into the great inflation of the 60s, that were focused on aggregate demand, that didn't really see a point of differentiation between increasing supply side or increasing aggregate demand. In fact, when they cut taxes, Walter Heller was a new Keynesian, and he was the head of the Council of Economic Advisors for Kennedy, when he pushed to increase capital investment through accelerated depreciation and tax cuts that were passed by LBJ after JFK was assassinated. They didn't differentiate between government spending and reduced taxes, but there is a big difference. And ultimately, they ended up advocating cutting capital or disincentivizing capital spending in the late 60s because they thought that was causing inflation. It clearly was not. So that was the supply side argument here. And then we wound that up by saying disrespect the sell side at your peril. So moving on to the next section, which was quite related to this whole supply side discussion, which is tax and spend. Now that we've gotten most of the details of the American Jobs Plan and American Families Plan, it looks like the aggregate amount of money they're looking to spend is about $4.45 trillion, and they're looking to raise taxes by $3.55 trillion. One of the core assumptions in the way that they're structuring these plans is this idea that the Tax Cuts and Jobs Act raised the deficit. That is false, patently false. In our opinion, we have a chart that illustrates how government receipts as a percent of GDP did not go down after the Tax Cuts and Jobs Act was passed in 2018 and 2019. They were stable. Tax receipts are generally endogenous to economic activity, meaning if economic activity picks up, and it in fact did, growth was stronger in 18. It softened a little bit in 19 because of the trade war and the hit to business confidence associated with that. But tax receipts were not impacted by it. The reason that the deficit went up in 2018 and 19 pre-pandemic was because of the spending deal that the Trump administration negotiated with Nancy Pelosi and Chuck Schumer against the objections of Paul Ryan and Mitch McConnell. That spending broke the Budget Control Act of 2011 2% spending growth cap and took spending back to 6% growth, which was its post-World War II average. That's what blew the deficit out, the spending, not the tax cuts. So that whole core assumption in how they've structured their spending and tax plans is just incorrect in our opinion, and will likely imply that they'll ultimately collect a lot less tax than they expect. This was the conclusion of several tax policy think tanks, the Penn Wharton Model, Tax Foundation, and Tax Policy Institute. It's our own analysis as well. And spending is endogenous, and no doubt the government will wind up spending more than they say they're going to spend. So no surprise that this 2s/30s real rate curve, that is our proxy for expectations around further government spending, stopped flattening. It had been flattening since the American Rescue Plan was signed in mid-March, and it actually steepened aggressively last week, underscoring how the market expects that supply will start to put pressure on the back end of the real rate part of the bond market. One of its turbocharged cousins, if you will, crypto and Bitcoin, took off again last week. And again, as digital gold, that's very much the same concept. So that's it on that. Again, that 60s analog looms large. Initially, this will not be a big negative for the markets. If anything, it's a bit of a net positive, not for the bond market, clearly, but for equities, because it could help increase growth in the short run. But in the longer run, the inflation problem looms quite large. Next section of the note was all about the labor market. Again, our paid subscribers will get an extensive labor market book that'll go through a lot of this. But the bottom line here is we've got payrolls coming on Friday. There's some very big estimates. I've heard people having estimates for job growth as big as 2 million. And while there's several indicators that point in that direction, so for example, pandemic-related initial jobless claims were averaged 134,000 per week in April. That was 310 in March and 428 in February. So those have plunged. Regular state claims averaged 612 per week in April. That was 722 in March and 805 in February. So clearly the layoff part of or separations part of the labor market has improved dramatically. The Conference Board labor differential, that was a very useful indicator for us that got us as optimistic as we were back last May, June, July, in the early stages of the recovery. That jumped from 8% to 24.7%. That is the differential between people saying jobs are plentiful and those saying jobs are hard to get. Jobs hard to get is down to about last peak low. And so that was a substantial improvement. That also relates to an unemployment rate, U3 unemployment rate of 4.2%. It was 6 in March. So we could see a big drop there. The U6 underemployment rate, this points to a 7.8% rate. That was 10.7 back in March. So we could see some substantial improvement there. But what has us scratching our heads about all this is the continuing claims numbers, which relates more to the hiring part of the labor market and whether people are going back to work, remains stubbornly high. When Chair Powell was asked about it in his press conference, he cited a number of different potential factors: closed schools, people retiring early. There was a Wall Street Journal story about that over the weekend, and fears of the virus. Those are all very plausible explanations for why continuing claims remain high. What he'd skipped, no doubt for political reasons, was the generous unemployment benefits. So here we show a table, we showed it in our note and we'll show it in the video, that underscores how last cycle, when we rolled those generous benefits or extended unemployment benefits all the way out till the end of 2013, the strongest year for the labor market in terms of the participation rate, employment to population rate, employment growth, labor market dynamism, that is turnover, was in 2014. That's the 5th year of the recovery. That's supposed to happen in the first year. And that is what occurs when government provides too generous of benefits and doesn't remove them. We have a link to a New York Fed paper arguing that the end of those benefits is what caused job openings to explode in 2014 and really helped less skilled parts of the labor force. So this is the big mystery that's going to hopefully get resolved to an extent, at least on Friday. And again, this is what the Fed is really focused on, is progress in the labor market. We thought that Chairman Powell's discussion of wages, his characterization, well, if the labor market was really tight, wages would be going up, was pretty disingenuous, actually, because wage growth, using the Atlanta Fed wage tracker, got cut by more than half last recession during the global financial crisis. It didn't go down at all. It remained near peak for the last cycle during this recession. So describing them as not going up is not really what you would have expected to happen. You would have expected them to plunge during a recession. And in fact, they remained right at the highs. So there is wage pressure. And as the labor market comes back, if any of these factors linger, we could see wage growth starting to put upward pressure and the Phillips curve come back to life, so to speak. So that's it. Friday's obviously a very, very big deal for us. And then the final section of the note was titled "As Good as It Gets." We had obviously those incredible earnings reports from the big 5 tech companies last week, as well as just outstanding results. The stock market's reacted a little better to those blowout results this quarter relative to the last 2, but still not as well as you would have expected based on the longer history of earnings surprise, if you will. And manufacturing surveys you would expect to start to flatten out. Those are rate of change indicators. Net revisions is effectively the PMI diffusion index for earnings. Those things will probably flatten out after earnings season is done. And that may be an argument for the equity market moving into something of a range for the next month or so. We do not, again, believe that there will be a correction without policy tightening, but we may be stuck in a range here a little bit because of that as good as it gets range argument starting to become a pervasive narrative. So that's it for me this week. As I said, we're going to be traveling. We'll be up in Boston for a couple of days. If anyone's in Boston and wants to potentially get together in person, I've been fully vaccinated on that Monday, that's a week from today, I'll be around. And then I'll be in New York City for a couple of days, Tuesday, Wednesday, Thursday. So again, if anyone wanted to try and get together and have a person-to-person discussion, give me a jingle. Barry Knapp, Ironsides Macro. Have a good week, everyone. I can't wait for payrolls on Friday. See ya.